Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 11th, 2023. It is 2:19 p.m. Eastern Time as I'm starting the video, and what I'll do in this one is a very brief update on the equity markets. I'll do an update on Apple, of course. We had a breakdown below the trend line yesterday. I'll update that stock. Want to look at some of those bottom tier stocks. Just over a month ago today, I think I'll get to that. I think it was June 6th, if I remember right. I started highlighting and focus on the bottom tier, what I don't want to call them crap stocks, but for the most part, yes, the laggers in the NASDAQ 100, the lowest weighted components there, saying that as long as the market held up, and that's where I think the opportunities lie, not in the top components, which had led the way most of the year. So I'll get to that in 1 second. And then just quick updates on the other opportunities right now. It's all about, trying to make money wherever the opportunities are. The market's going sideways now for over a month. So you're not making money on the indexes, whether you're long or short, unless you're actively trading. That's a whole different ballpark. I'm talking about swing and trend trading. So we'll look at updates on wheat, natural gas, crude oil, and then I saw a request for an update on the energy sector ETFs, which I'll do. So sounds like a lot, but it won't be too much. I think I can do this one in under 30 minutes. Starting out here, NASDAQ 100. Yesterday we hit and remain. As I stated, somebody asked did we break down? No. Although we had a breakdown in Apple, replied to a question. Most importantly, and the reason it's not an all-in moment, even though Apple broke down, is of course the NASDAQ 100. The index itself remains above trend. We hit it yesterday. We had a divergent low, that is positive divergence. So far, it's been a very muted reaction, but it's still a successful defense. We're right on the trend line right now as I do the video. So this trend line is getting long in the tooth. I have a high degree of confidence it'll crack sooner than later. Most likely give it a little bit better than 50% odds that it'll break down before making a marginal new high. But if we do make a marginal new high over the next week or so, it'll be again, if it's only a marginal, meaning a slight new high over the previous highs, it will simply be an extension of these divergences that have been building now for quite a while. And so no technical change from that perspective or point of view with the divergences. So again, so you need to see this trend line break. That could happen today, tomorrow, next week, or next month. If that breaks in conjunction with other things I'm looking at, the S&P 500, I'll look at the market leading stocks, just about everything else, some key sectors. That will be increase the odds that we're going much lower. It'll be a sell signal, an objective short entry, et cetera, et cetera, et cetera. Right now, as I said yesterday, and there's really no change. That's why I haven't given you anything all day. I've been scanning. I've gone over hundreds of charts today looking for setups and ideas, and I'll get to that in a second. So that's it. We're on trend. Wait for a break there. Now, I added to that comment yesterday when somebody asked me, hey, didn't the NASDAQ break down? I said, no, not yet. We were, as I typed yesterday, right on the trend line. And I want to point out, which I did in that comment, that the NASDAQ 100 tracking ETF, QQQ, is slightly above its comparable trend lines. That's off the March low. So a little bit more room. And ideally, you want to see both of these go, because I've seen this before. What happens sometimes, the futures break down. There's a subset of traders that only trade the futures, and so they may short, seeing a sell signal. But there's also a very large, if not larger, subset of traders that trade the indexes in the actual trading session, such as the index ETS, QQQ. And so sometimes NQ can break down, and then QQQ hits and bounces off support. So this will be help to solidify a sell signal when you see both of those trend lines taken out. And again, you can see, if you want to replicate it, look at these reactions there off that mid-March low, several reactions along the way. And at least that's the way I have this one drawn. Now, the leader of the pack is Apple. It is a big one. It's not the be-all, end-all, but it's certainly an important stock within the NASDAQ 100. Let me queue up the charts here. Apple. And so we had a pretty clear and clean sell signal yesterday on a breakdown. We had a pretty solid close, nothing huge, but we have follow-up today. And so that helps to keep this sell signal intact, gives me, an additional check mark. We're down below right now yesterday's lows by a slight margin. So if we close below yesterday's lows, like I like to say, the redder the better. When you have a breakdown, farther you get away from there, the greater chance that breakdown is going to stick, and at most likely a back test. So I do have that check mark there. And like I said, I would love to have that check mark come, shortly after earnings, or even in between, smack between the quarterly earnings. Unfortunately, Apple's going to be reporting. They usually report on around the 28th of the month. I haven't checked it this month, but it's always 27th, 28th. I don't think it'll be any different this month. So we have just a couple weeks. Typically, stocks will go into somewhat of a holding pattern, not make a very large move right in front of earnings. Although I have seen periods, this is a crowded trade, and you could get a rush for the exits. A lot of folks wanting out. Anything's possible. Like I said yesterday, take it on face value. Me personally, I passed on shorting Apple individually only because I still have some exposure to the NQs, and it's just it's an overlap trade really. But I may add this one on, and at least in some of my select accounts, just not in my active trading account right now. Anyways, that's Apple. I just wanted to reiterate or highlight that the breakdown's still intact and follow through so far today. And like I said, a breakdown is a breakdown, and it's not like it occurred one day before earnings. If it occurred a day before earnings, I'd say, don't even bother. Remember, Microsoft did the same thing back here. This was the Microsoft. I believe this was the last earnings right here. So you had that sell-off leading into earnings, see that nervousness, profit taking, getting out, and then earnings on these big tech companies come after the close usually, including Apple and Microsoft. They always report after the close. So the next day it gapped up. Again, I'm going from memory, but I believe that was the earnings date right there. I can remember that period. And so that's a case where, again, you wouldn't have wanted to put too much into that move down. Once the stock had reported, then it picked its next direction. That direction was up. Okay, enough on that. Like I said, Apple's check mark and most of those others that I've been watching are still have those check marks. Nothing hard yet. Alphabet, they're all coming up to report soon. So again, I don't expect big fireworks. Okay, so the opportunity, as I said about a month ago, let me pull that up for you. It was right here in this video. It was called NASDAQ 100 Leading Tech Stock Analysis, in which I did technical analysis and trade ideas on the NASDAQ 100 as well as its top and bottom components. So at the end of the video, and what I had stated is the top components, and I was right, they've gone nowhere. The risk reward was abysmal in my opinion, despite the current trend. And I know a lot of chatter, just buy the Qs, don't fight it, buy the dips. We've gone nowhere since then. That was, let's see here, the June 6th was right here. That's where we were, June 6th. And so the NASDAQ's gone up a whopping 2.89%, with the broad market, the S&P 500, going up even less. June 6th, right in there, these candles right on that 429.72 level, and we're up 2.37%. So to me, that's flat. That's the indexes go up and down 2-3% in a good day quite often. So let's just call that, we've kind of stalled out, and no big deal. Again, bulls say that's just needed to take a break, and we're going to consolidate and go up. Bears say that's the end of the run. These divergences tell me that the next move is likely down. No guarantees, but that's what it points out to me. So with that being said, let's just hit those that I covered. Time went through started out with Lucid. I believe that was the 100th, the bottom, the smallest cap weighted component in the NASDAQ 100. And it was at 628 right there. And one of the better looking charts in my opinion. Again, as I talked about, I use the word, they all have shit fundamentals, or they wouldn't be down trading at 52-week and multi-year lows. There was a given. It's the same thing, and I covered Beyond.com in that trade. Heard the same thing when I put that trade idea out there. The fundamentals suck. Yeah, that's what it is. This is the stage of the market. I've done this long enough to know that when you have a a big rally and it gets long in the tooth and the indicators are overbought at resistance, the momentum starts stalling out on the leaders that took you up there. This is what people go after. They don't want to buy Apple after a whatever it is, 50% plus run up in Amazon. And who does? It's just not, if there was a huge catalyst fundamentally, and technically you could make a case, that's fine. I've had many times I bought a stock that's gone up 50%, even 100% if I think it's got another 50 or 100 to go, but not the case in those. So this is where the opportunities were. And where were we? We're back then on the 6th. That was, what did I just say? We were at 628. And so that one's gone up. There's 627. You made, if you bought it then, and the case was made, 33%, which again overshadows, any gains or losses if you were long or short the indexes over the last month. That you would have made 33% here so far, and you would have made virtually nothing, made or lost a few percentage points in the index. So, and I added a line here. Let me see. I don't think that was on the chart then, because I noticed that today we're at resistance. So this is sort of an update to those trades if you took them. Minor resistance. And as long as the music keeps playing, I use that analogy, like musical chairs, a little, children's game where the music's playing, there's 8 kids in the room, 7 chairs, they're walking around in a circle, and the teacher stops the music. It was a game we played in kindergarten, if I remember. And, the last one without a chair loses. And so when the music's playing, that's when you want to engage these guys. Like I said, you don't want to be the bag holder. You don't want to be holding a basket of these lower tier stocks when the music finally stops. Right now, it's still playing. This is a nearly straight up trajectory. Again, 33% since highlighted back then. And when I say probably more to go, based on the chart and the scope of the divergences, it could easily go up to any or all of these additional targets that I have here. Again, as long as the music plays. So just recognize that. Just learn to recognize when things start rolling over, if these lower tier stocks start, fizzling out, or you start seeing a lot of false breakdowns. But this is still where the momentum is. The next one I covered in that video was the BYND, which I had thrown out before that. That was thrown out here as a breakup and a breakout. That wedge, and it's still up again today. It's still in that first target zone, up 46% now. Again, it doesn't take a big position, and that's the key too with these. You don't put the same amount into a BYND or a LCID that you put into Apple or Amazon, because those companies have solid fundamentals. Even if you rode out a correction, even if you rode out a bear market, if your time horizon's long enough, no guarantees, but you're most likely going to get all your money back. Not necessarily in these guys. All right. So anyway, this one still looks good. It's a bottoming play. And if this market is going to new highs, if I'm wrong that we're in a bear market and we're going to see another leg down, these are the ones that have a lot, still have, as much as this has run 40 something percent, it still has a lot more upside potential, in my opinion, in the next year or so than Apple and Amazon and Microsoft and the like. So that's why I'm doing this update for you. The one I covered in that video, next one was Rivian. And that was covered, where were we on that? That was the 6th, June 6th. So we were right here on this June 6th candle. Yeah, that's it right there. And this one so far is up almost to the second target, 88%. So again, this is where the opportunities lie. R1, I laid it out as a trade idea too, officially on that day to take out, I think it was 1610, whatever it was that day was taking out R1. I said it just needed to take out the day's high, and so that's where the actual, even though it was highlighted before that in that video that I did on the 6th, it's still up from that breakout, from the breakout point there, it's still up 61%. So, all right, we'll cover them all. Just again, the ones that were at the bottom then. Siri, already up about, where are we at on the 6th is right here. This candle somewhere. Yep, there's a candle on the 6th. Somewhere in there, I'll grab the middle of the candle. And we're up about 31%. Still running. We took out resistance there. And this one, I don't see really, it doesn't mean it's going to go all the way there. This is minor resistance here. I'm going to give you a level right now if you took it. And then the big resistance at 577. So if you took it and the music keeps playing, I would be a hard seller just before that 577 level. I don't know how much longer the music's going to play, and I would put good odds it's going to probably have a pullback before then. We're at the 200-day exponential now. The 200 simple's right above it, $5 resistance. So even if it's going to make it up there, this is if the market's going to new highs, and we're going to be higher, or we're going to be considerably higher by the end of the year than where we are today, then yeah, it's got a good shot at 577. Otherwise, I think the music will stop playing soon, if and when the big fangs roll over. Remember, it's earnings season. We're probably going to have a good idea in the next few weeks. Once Apple and Microsoft and Alphabet, they're all out of the way with their earnings, I believe the market will pick its next direction. Yes, I know, we've seen breadth improvement and all that, and that's part of this too. These crap stocks, this is what I call the dash for trash. And again, there's nothing wrong with it. This is Tinder versus Match.com. You're gonna date these stocks. You're not gonna marry them. You marry Apple, you marry Amazon and Facebook or Meta and all those. You date. These are in and out, wham bam, thank you, whatever. All right. So and again, that's where the opportunities are right now. A couple more. Zoom hasn't taken off yet, but that was one of the bottom tiers. That's all I did. I highlighted the top the bottom 5. It did break out above the trend line. Remember, I gave you this down trend line, but it's not moving yet. Sometimes you break out and you're back testing. I think if it pops this level, then it's going to run. Again, I said this yesterday, make sure to scrub for earnings. You don't want to buy one of these the day before earnings, because it's either going to gap up, especially these low price, beat down, most likely heavily shorted stocks. They have the potential to shoot up, but there's also something wrong with them if they are trading at, Zoom. Zoom was one of the big COVID stocks because everyone started doing the video conferencing thing, and that's when people went back to work. Down 90%, and the fact that it's still down, there's probably some problems. And now, if it pops, can run up here to that former third target. I had it as a trade idea back here. We hit T1, T2. It reversed shy of T3. Then I gave it again as a trade idea here. We hit T1. So there's kind of a pattern. It's had these pops, and I just want to say it's, again, if I had to pick Apple or Zoom right now and put my money in with a 10% stop loss and let it run, Zoom all day long over Apple, despite the difference in fundamentals between the two. This is just a better looking technical chart coming off these big divergent lows. ENPH I didn't talk on. I just covered it in there, and it's not. I wrote it down here on my notes. Towards the end of that, I just clicked through a few and I didn't comment on them. It was ENPH and ZS. ZS, when I showed on the chart, it had a breakout here I mentioned, and then it had just taken out that 142.13 resistance, and it back tested. So here's one, you're back above the 200-day moving averages. You broke above resistance 142.13. You back tested it for about a week and starting to move over. So you could take a shot. And again, I'm giving you these trade ideas. Take it or leave it. If you are bullish on the market or just agnostic and you're just looking for objective trade ideas, that's what I'm showing you here. Where to buy it, where to stop out, where to sell it. Again, as long as the music plays, it's going to continue to run up, and I'm probably next target would be somewhere around there with a minor resistance level here, 170, a little shy of 171. Okay, let me just move on to the other ones. We'll make it a quick video. So wheat, remember wheat was a trade idea, long trade idea, rallied up, hit T2. At the time we hit T2, I thought there was a strong enough case for a pullback to book profits and even short it, which we did. Covered there. I said you can buy, which I took a shot, took a lot at T1, but I said not a heavy lot, just a partial lot. Then I was going on vacation, so I said the next, if we go down there, you'd want to not add until you get to a back test. So far we've been back testing the trend line. We've held it, but we're not moving up. But it still looks good. You can still take a shot here. I think what they stop, sorry for all the lines, below these recent lows, because we already back tested. And again, the problem with back testing is you may continue to back test. You have to decide. Now, again, if you buy it here and you want to allow a little bit wider stop for a second back test, no problem. Because if you look at the RR, the risk reward ratio, let's say we back test here in a few days, that's a couple days, that's only a 4% downside. You could have a stop below there, let's say a 6, maybe even 7% downside stop loss, I'm sorry. And your profit potential, if it hits my fourth target, it's going to be 32%. So that's an attractive risk, very attractive risk reward. So that's how we got to look at these. So far, to just kind of summarize it, keep it very simple. You have a nice, very clean, well-defined downtrend line, an impulsive breakout, which is what you want to see, and so far nothing more than a back test. And so that's, quite often when you break out, you back test a trend line or a horizontal level, and that's what you've done here. And we had big divergence, and that's that. So wheat still looks good. UNG, I've been a fan of the energy commodities lately, oil and natural gas. And UNG, we had that initial lift here, went up, hit these first two targets, and it's really just, to me, it looks like it's consolidating here. Obviously the strong downside momentum is over, at least for now. Now, if you're a glass half empty kind of gal or guy, then you're going to say, well, we're going to break down. It's just consolidation, and we're going to break down and have another leg down. If you're glass half full, and I'm just that way only because I'm looking at the charts telling me to be positive divergence, potential basing patterns. Pretty much if we clear out that T2 level, it was already hit, we should rally up. And I'll most likely add additional targets because this is a potential bottoming play. That's a pretty potentially powerful basing pattern there. And that should help the energy stocks. Obviously, the energy stocks respond more. Most of them, again, depends on which company, but crude oil has a bigger impact, especially big energy like Exxon and Chevron. USO continues to move up. Pointed out, we had this divergence here on the 60-minute chart recently, and it's been rallying off this divergent low. The last divergent low we've had so far about a 11.5% rally. This divergent low here, we rallied about 25%. Bigger picture is I can't make a screaming case to buy it. We're still in this kind of, it is a downtrend. It's mostly sideways lately. We've been moving down, and now really we are, trading where we were for the last few months, where it's not a very well-defined trading range. I'm just going to circle it there. But if we can pop that, then we could make another big run up in crude. At least for the near term, the momentum's to the upside, and we're coming off that divergent low. And that's also benefiting the energy stocks like XLE. This is where I had a request for an update. There's the downtrend line. Remember, this was a trade idea, shorted way back here, hit T1 pretty quickly, went up, never exceeded the reasonable stop or even the entry point. I forget exactly where it was. Then went on, hit T2, hit T3. That point, we bounced. It was pretty decent support. We had a reaction, and we've been bouncing down off this trend line. But look, we just broke out recently, and that's because oil and natural gas have been moving up. I'm trying to circle there, but you can see there's your trend line right there. As I extend it, there's a breakout candle right there. So near term, there should be, I think, some more upside here. Probably carry us up to about that $88 level right there. So we'll just list that as a target for you if you're long this one at this point in time. Ultimately, well, we'll see. Like I said, I've been saying it for a while now. I don't have super strong convictions on crude oil at this point in time, but near term, the momentum and the technicals seem to be bullish. I always say you get more bang for your buck if you're going to buy, if you're bullish on crude oil, and just like when you're bullish on the euro, you can buy gold, and gold's going to go up if the euro goes up. Or you can just simply leverage it up. If you're right on your call on gold, you can buy GDX and you're going to get more bang for your buck. It's kind of the same way when you trade the energy complex. If you go XLE versus XOP or even XES, XOP will tend to go up more. It goes in the same direction. These are the oil and gas it's oil and gas exploration and production ETF. You do have the same top holdings, Exxon and Chevron, but then you have some other ones in there, and they're just higher beta companies. And so you can see they already triggered a buy signal a little while ago on that break of that downtrend line right there. I've had that downtrend line on the charts since, created that back in April, on April 4th, updated it, I guess, on June 14th. And so it's broken out, back tested, and we're moving up. And then XES is the ultimate one. If again, it's all about getting the call right. Get the call right on the energy sector, you're just going to get more bang for your buck trading XES. And that one broke out way back here. That downtrend line I had created back on June 5th, have not modified it since. There's the breakout, back test, positive divergence. This was the best looking sector. I believe it was highlighted back then too. And it's ripped. After the breakout, it back tested right again at that nice support level right there, 67.39. And it's already up about 29, almost 30% right there. Would I chase now? No. So it's already met the measured target of the wedge, which is the widest part. Here's your wedge, that line and that one there. Widest part of the wedge is right here, so that would be your measured target, something like right about, it's already exceeded that. So now, does that mean it can't go up? No, absolutely not. If crude keeps going up, this one will keep going up as well, and it'll help if natural gas carries as well. But I wouldn't be chasing it right here. Maybe on a pullback, if you're looking to buy it, somewhere around this level. You had some consolidation here, so if the charts of crude and or natural gas still look constructive, particularly crude. Okay, and that's it. So in summary, pretty much the same thing I said a month ago. The opportunities do not seem favorable in big tech. They've certainly stalled out recently, and in quite a few cases started to break down some support levels. So still, like I said, you can always trade a long short portfolio if that's what, even just for the indexes. Let's just say you want to trade the NASDAQ. It's be long the most bullish and short the most bearish. That's somewhat of a hedge portfolio, and that works well in this kind of environment. If you've been had you been short the big fangs for the last month, let's see. You can see here. Let me just look at them here. Apple, well, you're back down to probably about where you started them, back in June 6th, a month ago, maybe a hair higher right now. I'd have to come down here. There it is. Yeah, a hair higher, but certainly looks like it's headed lower. And Microsoft trading, where it was back all the way in end of May. So you can see Alphabet down from where it was a month ago. Amazon rolling over, pretty much trading where it was a month ago. Nvidia, really, again, if I look at where it is today and where it peaked right here on May 30th, right after earnings, you can see we're again, stalling out. So if you go back to the bottom tier, and you can see it's a whole different story. Let me just reverse my weightings here, capitalization. Here's the bottom tier. Whole much different story you can see over last month on just about all of them. Moving up, there's eBay, FANG, even Walgreens, WB, another beat down one coming off a multi-year low right here. Big divergences in place. Again, it's all about risk reward. And, it's a company I doubt they're going away anytime soon. They've obviously had some problems fundamentally. I might tweak that trend line like that, and it gives you a big wedge. So really right now, it's almost the same story as it was a month ago. The only thing I'll add, and I'll wrap this video up, is please don't forget it is earnings season. Be careful what you take and what you already hold. And just make sure you're aware if and when those companies are going to report, and do they have a history of making big gaps up or down following earnings. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.